All right, recording now. This is Tuesday, November 22nd, 2022. All right, and we're just looking at my course pack for chapter 7, which is the title of this chapter is Fraud, Internal Control, and Cash. And so half of the chapter deals with internal control, and we're going to talk about what that means, which is you're really looking at preventing fraud. Honestly, you're trying to make sure you have controls in place so that you're not providing opportunities for people who might commit fraud. And then cash management. So chapter 6 starts with some of the balance sheet items. So we've done inventory, and now we're doing cash. And then in Accounting 202, we'll go on and do accounts receivables, different types of receivables, current and long-term liabilities, stockholders' equity. So Accounting 202, we're going to kind of work our way down the balance sheet, and then we're going to do the cash flow statement. But that's for another class. All right. So we're going to talk about internal control. We're going to do a bank's reconciliation, which is probably something you've never done before, I'm guessing. And then some cash management concepts. And then when we do a bank reconciliation, there's about 4 or 5 correcting journal entries we have to do. So we'll do those as well. And, and I don't know why I have monopoly there. I think it's because that's the end of it. So we talk a lot about, why would people steal? Why do people steal from a company? Would you report someone stealing? Have you seen someone steal at the places you've worked? So Hamza, have you had any experience with seeing somebody steal or hearing about somebody that had stolen something? A small thing, like a shoplifting or something like that?
Yeah, probably I have.
So one way, do you want to share it or no?
No, I've seen people like, my uncle used to have a store, and one of my friends, he would always take like a couple of snacks in there.
It's very
Well,
common.
I'm pretty sure my uncle knew about it, but still
didn't say
technically
anything.
stealing, right?
It is technically stealing, but then and that's a good example, because if your uncle knew and your friend knew that your uncle knew, then is it really stealing? Technically, yes, of course it's stealing, but and companies are the same way. If they let it happen, it doesn't mean it's not stealing, but the company is not doing a good job with the controls. Okay. So my favorite example is if you get home from the grocery store and you realize they didn't charge you for something, would you go back to the store and say, hey, you didn't charge me for the Pepsi I bought? It's not on the receipt. Would you go back?
Yeah.
And, maybe the store is a half hour away. Would you get in the car and go back? I don't know. I don't know that I would make that trip just from the convenience of it, but it is another example of what we're talking about, and how much money is involved. And so the homework deals with a lot of these concepts, elements of proper internal control. And then we have you have elements, which is kind of a theory. And then we have very specific principles of internal control. And so after we've learned these concepts, the way you'll show you understand it is the homework will give you different scenarios. This is not the homework. These are just activities that we can do. And you get a scenario and then you say, oh, which of these, is there any internal control issues? Is there a weakness where somebody could steal? What is it? And then you'd say, what principles might be violated? And by the principles, we're talking about these things. And we're going to talk through what those mean, okay? And how you do it. So we have the principle and how you do it. And for example, we'll come back to that. Okay, I just want to give you an overview of that. And so there's a lot of your homework and the quiz that deals with these internal control concepts. And then we have the bank statement, the bank reconciliation, and we walk you through that. Okay, so let's go back over to the PowerPoint and tell me if you can see the PowerPoint right now.
Yeah, I can.
Okay. And you can see that same kind of, and then the only journal entries we do here are if we have to make correcting journal entries for the bank reconciliation. So it's about 5 journal entries. And okay, so what is fraud? It's dishonest acts that result, and it's real important here, personal benefit to the employee, and it costs the employer. So stealing from a cash register, taking office supplies home for personal use. Employee, and sometimes, a lot of times when I'm teaching this in class, students will share incidents of, yeah, I have a friend who comes in to work, they clock in, maybe it's a mall job, maybe they're at, South Center or Bellevue Square. They clock in and then they run down the mall and go get coffee. They're not working, but they're getting paid for that. Is that stealing? And it's like, yeah, it is. You're putting extra time on your time card that you didn't work. And of course, in the world of accounting, creating false accounting statements to create an increase in stock value and then selling stock before anyone finds out. So you, what they call, inflate the stock value. So we have this triangle here, this fraud triangle, and it's financial pressure, opportunity, and rationalization. Okay. And I really want to help you understand what that is all about. So what is financial pressure? That's on the person who might decide to commit fraud. Okay. Classic example is, I have a lot of debts and they're coming due and I have no money. That's pressure. And, as students, you probably feel pressure when you have bills and all of that. You have to pay your tuition. You have to buy books. Oh, by the way, for Accounting 202, you don't have to buy a book. You already have it.
Oh, it's the same book?
Yeah.
Okay.
I owe money. My friends invited me on a really fun trip and I really want to go, but I don't have money. My car payments are so high. This is a big one. I've seen this one a couple times with fraud. My husband had surgery. We have a lot of medical debt. We don't have good medical insurance in this country. And so a lot of times people who don't have medical insurance, all of a sudden they owe $50,000 or $100,000 in debt. And that's financial pressure. All of those things create pressure on a person. So that's inside the person. Rationalization is inside the person. So they start to think, well, they don't pay me enough. I earn a low wage. They owe me.
Yeah.
I got passed over for promotion. They make so much. The boss makes so much. They don't need the money. And this one I've seen twice in fraud cases. I'm only borrowing the money. I will pay it back. And then everybody's doing it, even the supervisor, coming in late, having someone else sign in, taking supplies. And, we always say, never rationalize something that feels wrong. Okay. So those are 2 parts of the fraud triangle. The third part, and those 2 parts are inside the head of the person thinking about committing fraud. The third one is opportunity. Okay. So that's on the company. The company can't help the financial pressure unless they give people raises, which I believe in. They should pay fair wages. But in general, if an employee gets a raise and still feels like there's never enough money, company can't help with that. If somebody has pressure in their lives, that's outside. The company can't control that. They can't fix that. But here's where the company can take action, opportunity. So I always ask students, it's break time. Would you leave your wallet on your desk and go use the bathroom or go do something that doesn't involve money? Would you leave your wallet in the classroom on your desk? That's opportunity. Most of us wouldn't do that because we don't want to tempt somebody. Tempting people in my cultural background is really wrong. You should not tempt people. And so companies have to make sure they're not providing opportunities for fraud. And that means they have to have good internal control. Okay.
Yeah.
Now that's on the company, and that's where the whole conversation of internal control comes up. And that's, so we go from fraud to internal control. There's some pretty big legislation passed by Congress in 2002 called the Sarbanes-Oxley Act. And it was in response to a lot of big fraud cases that happened. And there's a whole bunch of, you can read about them if you want. And a lot of them were in the field of accounting, which is really awful. And they demanded better control over financial reporting. And they demanded that companies consistently test that their controls are working. And so for people who are majoring in accounting, that was that created a lot of jobs in audit. So for better or worse, there's more oversight. And they also created the Company Accounting Oversight Board. And so independent auditors are hired by the company, but the Public Company Accounting Oversight Board is a government agency, and they audit the auditors. So the goal of internal control is to safeguard the company's assets, of course, cash, inventory, equipment, accounts receivable, all of those things. Assure that the financial statements are reliable. And then this is kind of a fun area, and a lot of students like to go in this area. Assure efficiency of the company's operations. So even though it's not illegal to be inefficient, but good internal control says don't waste a lot, use the company's resources wisely. Don't waste a lot. And so create more efficiencies than you can, and then be in compliance with laws and regulations. All right. So we set up a control environment, which means the company is committed to having internal control. And let me tell you something, most company leaders, that is not a high priority for them. Their goal is to develop markets for their products and services, to do leadership training, to develop future leaders, to find customers, to get good supply chain, all of that. They don't think about internal control as a top priority. And so in order for it to be effective, top management has to commit to it. So companies have to look at their own risk and assess it and decide, are we in a risky situation, and do we need to add more controls? Control activities, develop policies and procedures that increase internal control, communicate them to the rest of the company, and always monitor and follow up. It's not like writing a report and you stick it in a drawer. You have to keep monitoring. All right. So 2 types of internal control. One is prevention and one is detection. Ideally, companies are doing prevention. It's like health, right? Prevent it by eating healthily. Eating healthy foods. Don't get cancer. Eat the right way as much as possible so you don't get all these diseases. But if the worst happens and you have fraud, then the job is, can we discover it as soon as possible after it happens and stop it and plug the holes and the weaknesses in our system? All right. So these are those 8 things that I showed you earlier, and we just need to define them. So, and once they're defined and you have a couple examples, Hamza, you'll be able to do the homework a little easier. Okay. So establishing responsibility is where we say, control is most effective when only one person is responsible for a task. And so that means that you don't have 30 people on the same cash register. You have one person, one cash register. So like you go through the grocery store, and then sometimes that person is going on break and the new person comes in and they both count the cash. They agree on the cash count. And so they know that they don't say later, oh, it must have been hers. Or no, it must have been his error. You know exactly how much cash you had. And that's why we use passwords, so we know who's responsible for what. So segregation of duties feels similar to establishment of controls, but it's really more about a check and balance. Okay. So related duties. So for example, record keeping, and that would be like accounting. That would be like the person who pays the invoices, the bills come in and they pay them. Related duties, including physical custody and record keeping, should be separated. Okay, so what that means is if you buy something and you get approval from your supervisor to buy it, and then the invoice comes in and you turn it into Sophia in accounting, she sees that your supervisor approved it. She pays the bill. It's separate. You have the item, she pays the bill. Okay. Sophia doesn't buy the item, keep the item, approve that she bought it, and pay the bill. You want that check and balance there. So you can say
multiple people to have the same story, right?
Exactly.
Like if you're in charge of everything, you can make it, the truth is whatever you say it is.
The truth is whatever you say it is. And for small businesses, this is almost impossible because there's only one or two people in the business. And so it gets really tricky.
Yeah.
And so sometimes with small businesses, you have to be very creative on how you can get that check and balance. So this is another way of saying it. Record keeping of assets should be separate from physical custody of assets. So the reason for that is I can say I received something and I can pay the bill, but you don't know that it really got received. I'm controlling that whole story. And so there was a big fraud at Starbucks a long time ago where someone was creating fake vendors, fake suppliers, and then creating fake invoices and then approving the invoices to be paid. So for example, the invoice was for consulting services. And then they were paying the fake supplier, but they actually had access to that bank account. So they were just paying themselves. And because it was consulting services, there was no physical asset. It took a long time to catch it, but they always catch it. They don't always catch it. They catch it often by observing that somebody has a much richer lifestyle than their pay. So that person had a house with like 5 grand pianos and they had a car collection, big cars, and somebody's like, well, she works in accounting. How does she pay for that? Is she, did she inherit all this money or something? And they started wondering and they got her. So
was it the IRS or was it Starbucks that
Starbucks. Yeah. All right. So another thing that helps is to hire competent personnel. And so, these are called human resource controls. So you would, 3 things, you bond employees, you require that they take vacations or rotate jobs, and you conduct a background check. So you're going to hire somebody, they give you a resume, they tell you they've worked in all these places, and then it turns out they just lied, So you should take the time. Everybody's busy, but you should take the time, pick up the phone and say, did this person work for you? What are the dates they worked for you? That kind of thing. And just a simple check, and you can save yourself a lot of trouble. If you have more than one employee, teach them to do each other's jobs and rotate the jobs. And that way somebody else sits at that desk and has to do the work at that table, at that desk. And if there's some oddity, they're gonna find it. Okay. And that in the old days in banking, they made the banking employees take 2 weeks vacation because they said it takes 2 weeks to find fraud, but now they've got it down faster. And then bonding employees is a funny thing. It sounds like if I'm a bonded employee, I must be really special. No, it just means they took an insurance policy out on the employees. And then if somebody commits fraud, the insurance company pays for it to reimburse the company.
That actually exists. You could take out insurance against somebody committing fraud in your company.
Yes, it's called bonding. Yeah. Yeah, we had
Wow.
actually we had a church accounting bookkeeper, and she stole like 55,000. And it was a time in the church where we had lost the pastor, we were in between some people, so a little more confusion, a little more confusion, and that's a
Yeah.
perfect time to commit fraud. And it was a
Yeah,
case
that is.
where her husband had medical issues. They owed a lot of money. She was just borrowing, that kind of thing. So that was a sad story. All right. Documentation, you should be able to track every transaction, some sort of a control number where you can find all the documents. So you should be able to trace every document back to the person that initiated it. You should have approval signatures, and then companies still issue checks. And so that if they should account for all the check numbers and make sure there's no missing checks. Because if somebody rips a check out and writes it for a big amount of money, then that's an example of fraud as well. So just don't provide the opportunity. Keep the checks locked up. All right. So this is kind of a funny one. It's develop a budget. And so if you say, we want to spend this much on training, this department is going to spend more on training because they have new employees, this department is going to spend less. This department is going to spend more on education reimbursement, et cetera. And so you have this plan for the year, and then you go through and you look at your actual budget, your actual spending compared to your budget. And what it does is it gives you a way to talk through, oh, why is this so high? Or, what happened here? And it's just another way to monitor. And it becomes both prevention and detection. So just less ways to hide things. Okay. Maintain good records. So that means you have a good accounting system that's up to date. So talking about my church, this was like 10 years ago, the bookkeeper was way behind. And I remember asking her for a report like 3 times. It was a budget of like $200. And she kept saying, I'll get to it. I'll get to it. She wasn't keeping up. But more importantly, she didn't want to keep up because she didn't want anybody to check her work. So you should reconcile the books. You should take physical inventory, adjust the books if you need to. And then here's 2 things that we do a lot in audit. We actually take a list of all the customers that owe us money, and we write a letter to them, and it's all done by the computer now. And we say, please confirm that you owe this money. And we do the same with our suppliers. Please confirm that we owe you this money. And you're just kind of checking in to make sure the accounting records are accurate. Okay. A couple more. Physical electronic controls. Get yourself a safe. Lock up your cash at the end of the day. Have warehouses that lock. Have computers with passcodes. In some businesses, they have TV monitors. Like if you have a mini mart, those TV or a gas station, those monitors are really important. Time clocks, alarms, and key cards or ID cards. All of that creates a record, a trail, and controls. And then finally, last one, independent internal verification and audit. So most big companies have an outside auditor, but in internal control, you can hire internal employees to be internal auditors. And they go through and they do checks and they say, are the internal controls in place? Are they actually working? And then do we need any areas for improvement? And my first job out of college was an internal auditor for a department store. It was so interesting. I love that job. And we just did a lot of audits, mostly non-financial, but it was really cool. All right. So let's jump over here and let's go back to this. So here's your list. If you have a chance to, if you have a camera, take a quick picture of these items here. And I'm gonna give you a case and just to show you how it works. So
yeah,
got it?
Yep.
Okay. So then my question is, here's a good one. Scrap is inventory that is broken. either in the warehouse, or if you were a manufacturing plant, maybe they were working with it and they dropped it and now it's damaged. Rather than discard it, the company has a policy of filling a box up with scrap. And a lot of scrap has a value, but not as high a value to the company. But it might have metal, clamps, sheet metal, pieces of wire, copper wire, or even gold chips, but small. When the box is full, one employee hauls it to the scrap dealer, who weighs it and issues the company a check for the items. Depending upon the weight of the box determined at the scrap dealers, the check amounts vary. So for example, if the box weighs 200 pounds, maybe the scrap dealer gives the company 20 cents a pound. So it's not a lot, maybe $40 check. But it's a way of kind of getting the scrap and kind of recycling it and not just throwing it in the garbage. Okay. So scrap goes into the box, into the truck. The company employee drives to the scrap dealer. Scrap dealer weighs it and issues a check to the company. Can you find any internal control weaknesses in this process? Can you think of any?
I feel like the person taking it, there shouldn't only be one person taking it and receiving the check. They could just keep some of it.
How would they
keep,
keep, yes, how would they keep some of it?
They could just remove some of the scraps that are there.
You nailed it.
And then
Yes,
sell
good,
it themselves.
Yes. So they don't have to deliver 200 pounds to the scrap dealer. They can deliver 100 pounds to the scrap dealer and take 100 pounds to a different scrap dealer, right?
Yeah.
How would you protect against that?
How would you protect? Maybe informing the sellers of the amount that they're selling. So like the person who's going to purchase it, maybe if you send them a transcript of saying 200 pounds are going to be sold, and then when they get there, the buyer has to make sure it's the exact amount that you said you were going to sell.
Got it. I like that. So how would the company know they had 200 pounds?
Making sure that somebody's keeping track of it, like we're keeping it closed and weighed, keeping a book of every time new scrap is added. Somebody would record it, like the 2 more pounds has been added, 3 more pounds, 5 more pounds, like that.
Yes, that's good. That's exactly right. So all of these are true stories. So a company would weigh it before it goes, seal it, and then go to the scrap dealer. It's 200 pounds. You're going to get a 200-pound check, or $20, $40 check. So then they match it all up. Did we get that check? And then we close the loop by matching it up. Okay. So what internal control issue has been violated in the old process? So which one of these is violated? Could be more than one, but
let me see. Segregation of duties.
Correct. Yep. He's got control of the asset and he's got control of the record keeping. Yeah.
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 So.
And then
an establishment of responsibility. Say somebody keeping track of it.
Yeah, because this is I would stick with segregation of duties and then documentation. We don't really have any good documentation. Okay. So you have the idea. So the homework will be like that. Let's see. All right. I mean, you want to do one more? You can do another one. Let's see. Here's a good one. A small landscaping company buys rocks and lumber One of the project managers is responsible for ordering the lumber, which he does by calling up the lumber dealer and ordering a shipment over the phone. No purchase order is used. The lumber dealer delivers lumber directly to the job site and invoices the company once a month for all the jobs on one bill. So what's the fraud risk there?
That it's over the phone.
Yeah. So,
Yeah, so there's no record of that.
no approval. Just delivers it. No documentation, no approval.
Documentation.
Yeah. So,
and it's one person just taking care of everything.
right, exactly. One person's controlling the whole thing. So again, segregation of duties. The guy doing the purchasing is also doing the receiving. So we want that separate. He's ordering and he's receiving. We don't want that. And then we want some better documentation. So true story, one of my students, she came to that company as office manager, and she had the company start using purchase orders. So here's another triangle. When an item is purchased, you have another triangle. You have a purchase order. That's where you say, I want to buy something, and my manager has to approve it. So you have that check and balance there. Then you order, you place the order, you send the purchase order to the supplier. They ship it to you, they send an invoice. And then when it arrives at the company, the people who receive it see that it agrees with what's on the purchase order. And that's that because it comes with a packing list, and you do a receiver saying, yeah, that's good. And then once you match up the receiver and the invoice and the PO, then the accounting people say, okay, we'll pay the bill. Okay. So she put in a purchase order system, and the lumber bill went down dramatically. And they were doing the same amount of work. Okay.
Wow.
So this project manager, he was building a vacation home on the Hood Canal. And it was her belief that he was taking lumber from the company.
What?
Now, did the company fire him? No. He was one of their top employees, and they didn't want to fire him.
Wow.
So he had rationalized in his head, they owe me. I work hard for this company. They owe me. So yeah, it was crazy.
Yeah, it's easy to make things make sense.
You can convince yourself of anything if you want. Okay, I'm gonna stop this. Let's see. I want to stop the